Hello, speaking Forex. This is Gregory. In today's lecture, I will discuss a concept that I call price wave analysis. We use a price wave model to determine the overall direction of a market trend. Intuitively, we understand that as prices are increasing, we are in an uptrend, and conversely, we intuitively understand that as prices are decreasing, we are in a downtrend. However, as professional traders, we don't buy because prices are increasing, and we don't sell because prices are decreasing. This is too vague for us to use effectively. Instead, we need to be able to objectively define a trend's direction. We do this with a very simple concept I call the price wave model. So how do professional traders analyze trends using a price wave model? It's pretty easy, actually. For instance, for an uptrend, we know that prices are increasing. But to analyze this objectively, what we normally do is that we analyze the highs and lows of a trend. So an uptrend has higher highs and higher lows. This is your price wave model. So basically, you can look at the highs. Each ensuing high is actually higher than a previous high. And the same thing with the low. Every low is higher than a previous low. This is a very important concept to understand, because as we get to more complex applications of the price wave model, such as Fibonacci and geometry, this very basic concept goes a long way. So it's very simple and rudimentary, but trust me, it's very, very important for us to understand. So this is an uptrend. As prices are increasing, we have higher highs and higher lows. And for a downtrend, we have the exact opposite. We have lower lows and lower highs. So as you can see, each low is lower than the previous low, and each high is lower than the previous high. So you don't have a change in direction until the previous low in an uptrend is taken out, and vice versa, the previous high in a downtrend is taken out. But there's one thing that you have to understand. The high that you have to use has to be connected with the leg that makes the new low. So for instance, if we're looking at this downtrend here, okay, we have wave down, wave up, wave down, wave up, wave down. These down waves are called impulse waves. Okay, these small retracement waves, we can call it a retracement wave, but the more common term is the corrective wave. Okay, so the impulse wave goes in the direction of the trend, and the corrective wave goes in the opposite direction. Now these corrections are basically, it gives the market the time to recover. Basically what's going on is that when sellers are selling, they take profits. So it causes the market to stop in its momentum, and prices start to retreat and rest before it takes off again. So it's the same thing with an uptrend. Buyers are buying, then when there's no more buyers, seller comes into the market. Basically people are taking their profits and prices come down, then eventually it takes off again. Okay, so this is a phenomenon that you will see in any market, any time frame. It doesn't matter. They're all over the place. So in order for a trend to change, so for instance, we have a downtrend here. So we have lower lows and lower highs. For the trend to change, this high has to be taken out. Once this high is taken out and price pulls back, you would notice that now we have higher highs. And as that's taken out, now we have lower low. I'm sorry, we have higher lows. Okay, but remember, this high is significant because it's part of the impulse wave that actually took out the previous low. The reason why this is important, you'll understand very shortly when we get into sideways trends. So let's look at this up wave briefly. We're going to use the same concept. So the market is trending up. It's making higher highs and higher lows. And now it makes a sharp reversal. So now, as the market pulls back, we see that there's a new low established because the previous low was taken out. So now we have lower lows and we have what? Lower highs. So now we effectively have a trend reversal. So this is what it looks like when we have an uptrend, higher highs and higher lows. And then when the low is taken out, then we have a trend reversal. Now we have lower lows and we have lower highs. And the same thing here. We have a downtrend, highs taken out. So now we have higher highs and higher lows. So it's a very basic concept, very simple to understand. But before I go, I want to talk about a sideways trend. So a sideways trend can start off either with an uptrend or a downtrend. It doesn't really matter. So let's assume that we are in an uptrend. But let's say this particular leg. So basically this is what we call a sideways trend. As you can see, the last established highs and lows, let me change the color so we can actually differentiate what's going on here. So we have higher highs and higher lows in an uptrend. But as you can see, price action didn't take out the previous high. So it didn't take out the previous low as well. So basically we're trading in between this range here. And this is how channels start to form. Now you notice that we have these smaller waves that's between these extreme highs and lows. So you may be saying, well, if this low is taken out, does that mean that the trend is reversed? No, it has not, because these highs and lows are not that significant when it comes to evaluating the whole trend. The sideways trend is defined by this high and by this low. So if price breaks through here, we're going to continue with the uptrend. And conversely, if price breaks down below this previous low, we have a trend reversal. Okay, so we have the same thing as well. We have a downtrend, right? Same stuff, very basic. So we have a downtrend. A downtrend is defined by lower lows and lower highs. And let's say price made its way up, but it didn't take out the previously established highs and lows. So basically, we are in a sideways channel. We are in a sideways market now because the market has not progressed any further to the downside or to the upside after the extreme highs and lows have been established. So once price penetrates the previous high, the market has reversed. And the exact opposite is true. Once it takes out the previous low, the trend continues. So this is your basic price wave model. So always remember this when you're looking at charts. You want to be able to define the structure of price, understanding what the market is doing, and this is the most objective way that you can use price wave analysis to determine where the trend is going. It's much more efficient than saying, hey, prices are rising, so the trend must be up, or prices are declining, so the trend must be down. Yeah, it can be that simple, but when it comes to trading, we need to be more objective and really have a better understanding on how the markets work.